Hey everyone, welcome back to Corporate Dakota, the place where we uncover the hidden stories inside company reports. And in this filing, we have something really interesting coming up. Flex Limited has some big numbers to talk about. And believe me, things are looking quite dynamic. So before we dive into the nitty-gritty, if you love breaking down complex financial documents into simple, actionable insights, you absolutely need to hit that subscribe button. And hey, we've got a fantastic community growing on Discord, link down below, where we chat all things corporate finance. Flex Limited, a company that designs, builds, and delivers products for a ton of industries, just dropped their quarterly report. We're talking about their financial health as of the 31st of December 2025, and it paints a pretty clear picture of where they stand. Let's jump straight into the numbers. Looking at their financial status, their current assets shot up from about $12.8 billion at the end of March 2025 to over $15.1 billion by the 31st of December. That is a healthy jump, and a big part of that is their cash equivalents, which climbed from $2.2 billion to a strong $3 billion. This shows they are managing their cash very well. Their goodwill, which represents the extra value of acquired businesses over their net assets, also saw a slight increase from $1.34 billion to $1.37 billion. This usually means they've been making strategic acquisitions to grow. Now let us look at their liabilities. What is interesting is that their accounts payable surged from $5.1 billion to almost $6.4 billion. This is a crucial number. It means they owe their suppliers a lot more money. While some of this increase is tied to their growing sales, it is definitely a number to keep an eye on. Moving over to their results of operations, the company reported net sales of $7.05 billion for the 3 months ending the 31st of December 2025. That is up from $6.55 billion in the same period last year, a solid increase. But here is where it gets a bit more nuanced. While sales are up, their net income actually dipped slightly for the quarter, from $263 million to $239 million. This is a key point to analyze. It means their costs are rising faster than their revenue in some areas, or maybe there are other financial pressures at play for the 9-month period. Net income was $630 million, up from $616 million last year, which is positive for the longer term. Let us look at the gross profit margin. For the last quarter, it went from 9.1% to 9.6%. That is a small improvement, but it is still under 10%. This means for every dollar of sales, they are keeping less than 10 cents after paying for the direct costs of making their products. It's not a bad margin, but it suggests there is room for improvement in managing their costs. Their selling, general, and administrative expenses, or SG&A, went up to both in dollar amount and as a percentage of sales from 3.7% to 3.8%. This is basically the cost of running the business outside of actually making the product itself, like marketing, salaries for non-production staff, and office expenses. The increase, while small percentage-wise, suggests they are spending more to keep the business running. Now here is something that really stands out. They had restructuring and impairment charges of $5 million in this quarter, compared to almost nothing last year. This is tied to that missile strike in Ukraine they mentioned, which damaged their facility. It is a reminder of how global conflicts can directly impact a company's bottom line, even if it was only $5 million for the 9-month period. These charges were a much larger $54 million. Looking at their business segments, Flex Agility Solutions, or FARS as they call it, saw its net sales increase by 6% for the quarter. This segment covers things like communications and consumer devices. And Flex Reliability Solutions, or FRS, which includes industrial and automotive products, saw a 10% sales increase. That is pretty strong growth, especially in their industrial sector, pointing to demand in areas like data centers and renewable energy. The income from FAS stayed steady at 6.3%, not a huge change there, but it is stable. However, the FRS segment margin jumped from 6.7% to 7.2% for the quarter. That is a good sign, meaning they are becoming more profitable within that segment, likely due to that strong growth in industrial products and better cost management. For the 9-month period, FRS margin also improved significantly from 5.7% to 6%. This indicates a positive trend in their reliability solutions business. Interestingly, in their discussion about market risks, they highlight ongoing global economic conditions, geopolitical uncertainty, and supply chain issues. These are big, broad risks that could impact them significantly. They mention that tariffs have only had a small impact so far, but that could change if they can no longer pass those costs to customers. A really interesting point is this warrant they issued to Amazon.com NV Investment Holdings LLC. Essentially, it is an option for Amazon to buy over 3.8 million shares of Flex at a set price. The catch is, these shares have to be earned or vested based on Amazon purchasing Flex's products and services. This is a strategic move likely to solidify a key customer relationship. They recorded a charge of $5 million related to this warrant in the 9-month period. It shows how companies are getting creative with partnerships. Now, let's talk cash. They ended the period with a very healthy $3.057 billion in cash and cash equivalents. This is up from $2.289 billion at the start of the same period. This strong cash position is crucial for a company like Flex, which operates globally and needs to manage complex supply chains. And where is all this cash coming from? Well, their operating activities provided $1.272 billion over the 9 months. That is strong, showing their core business is generating good cash flow. A significant portion of this comes from their net income, plus non-cash charges like depreciation and amortization, and changes in their working capital. On the investing side, they spent $431 million on property and equipment. This is for things like new machines and facilities, which is essential for future growth. They also made an acquisition costing $40 million. Financing activities used $46 million. They paid down some debt and spent about $744 million on repurchasing their own shares. Share buybacks can signal that management believes the stock is undervalued, or it can be a way to return capital to shareholders. They also highlighted free cash flow, which is basically operating cash minus money spent on property and equipment. This number was $848 million for the 9 months, showing they are generating a good amount of cash beyond what they need to maintain and grow their operations. Flex operates globally, so they use financial instruments like foreign currency contracts to manage risks from fluctuating exchange rates. They have a substantial amount of these, with a notional contract value of nearly $5 billion in US dollars. This is a complex area, but it shows they are actively managing these currency risks. In November 2025, Flex issued new debt, including $600 million in notes with a 5.375% interest rate due in 2035. They also added $150 million to an existing note issue, bringing that total to $650 million. This shows they are actively managing their debt structure, likely to secure favorable interest rates and manage maturity dates. Now, for a bit of legal news, Flex has been in a dispute in Brazil over sales and import taxes. It looks like they've won a few of these battles, but there are still 2 outstanding. The amounts involved are significant, with one assessment being around 37 million Brazilian reals, which is about $7 million US dollars, and another at 60 million Brazilian reals, about $11 million US dollars. They are still waiting for a final decision on those. This is a good reminder that international operations come with unique legal challenges. And there is a bigger tax issue. A foreign tax authority had assessed a massive $167 million for various tax years. Flex has been contesting this, and they've now reached a settlement for $50 million. They had already paid some, and will pay another $20 million soon. This settlement, while large, is significantly less than the original assessment, showing some negotiation success, but it still represents a material cost. Scroll overall Flex Limited appears to be navigating a complex global environment with resilience. Their strong cash generation and improving margins in their reliability solutions segment are definite positives. However, the slight dip in quarterly net income despite sales growth, along with the increasing accounts payable and the ongoing legal and tax issues, suggest areas that require close monitoring. They are making strategic moves like using warrants to secure key customers and actively managing their debt. The missile strike in Ukraine is a stark reminder of the geopolitical risks they face. Flex's strategy of providing integrated supply chain solutions seems to be paying off, especially in their industrial and health solutions segments. Their ability to manage diverse global operations and adapt to changing market demands is a key strength. However, they need to keep a tight rein on costs to ensure that sales growth translates into stronger profitability. What is your take on Flex Ltd's latest financial report? Do you think their strategy is a winner? Or are there significant risks on the horizon? Let me know your thoughts in the comments below, and if you found this deep dive helpful, please give this video a thumbs up and subscribe for more. Don't forget to join our Discord community linked in the description for even more exclusive content and discussions. Thanks for watching, and we'll see you in the next video.